Should you debt recycle or pay off your home loan? This is a question a lot of borrowers ask. If you ask someone who is elderly, quite often they'll tell you just to pay down the debt. However, in recent years, it is seen to be more favourable to invest as soon as possible. Part of this is that it has just become so hard to get ahead that people are taking more debt and more risk because, let's face it, we live in really unique times. The theory is that as you pay down your home loan, you reborrow it back out and invest, and by doing that, you claim the tax deduction on the interest and get a higher return on the investment than what the cost of the loan is. This is known as debt recycling, but does the theory hold up? Is debt recycling and investing better than paying off your home loan? Well, it's not as straightforward as some people might think. Today I've got Kyle from Edvest with me. Kyle is a financial planner and employs investment strategies like debt recycling for his clients. I've got Kyle back on because he's done some digging into historical investment returns to try and get an understanding on things on a deeper level than just theoretical. The work he's done is actually really comprehensive. So today we're just going to go over some core information that'll hopefully give you a bit more context when making your decisions around debt recycling. Debt recycling versus paying your home loan off. Where do we want to start with this one?
Yeah, so I think just with debt recycling, first of all, it's not some magic strategy or anything like that. It's in between that, there's the investing step, and that's where the uncertainty comes in. So when I say that it's a no-brainer to debt recycle, I mean that if you've decided for that investing step, then it's a no-brainer because it just helps that equation. So with the uncertainty of investing, that we don't know what investment returns are. We can make long-term assumptions and look at averages, which we can here. There is that uncertainty that hopefully you're a long-term investor, you diversify, you keep costs low and tilt the odds in your favor, but there's still that market risk that we can't avoid. Whereas it's a bit of an age-old, question in personal finance is, well, should I invest or should I pay down my mortgage? And everybody has their own kind of take on it and different things like that. And when you're at different times in the cycle in terms of interest rates are high, or a lot of people have different opinions and things like that. It's a pretty old equation. It's nothing new about it. That I think probably debt recycling it's a little bit more, known how to structure it now. So that just adds an additional complexity.
Yeah, you're kind of touching on a point there where this is what I see from my side, where a lot of people kind of access equity, access debt to kind of invest. They're not investing in the average. They're generally picking something. So yeah, people tend to kind of overlook that investing part and the risk part of it. We're probably going to dig into some of the numbers around kind of returns and depending when you sort of decide to start. Yeah, it was really interesting when we talked about it kind of offline to see the differences in when someone started to do that. So why don't you just explain what's on the screen first, and then we can get into like some of the interesting numbers.
So what I've done is kind of, let's wind back the clock and say, well, when would have it made sense? And just so we can kind of, obviously, like the past doesn't repeat itself, but we can kind of use it as kind of a data point to say, well, this would have been that scenario if I did it in 1990 and so forth. So what I've done here, the usual answer that you'll see online, and it's not wrong, but it's has its limitations. So the usual answer to should I pay down or should I invest, the usual answer is something along the lines of, well, the share market on average has returned 9.42%. So that's the average since 1990 using this data set. And over that time, the average interest rate has been 6.89%. So they'll say, well, that exceeds it. So great, you should invest or you should debt recycle. And then using that, so that's pre-tax and different things like that, which we can get into. So that answers that. That's a pretty simplistic answer. It's not wrong, but I would say it's simplistic. What we want to do is we actually want to see that what makes up that 9.42 is a lot of different kind of years. And so there's a thing called sequencing risk, which is a pretty prevalent term when it comes to like retirement in terms of what you retire has a big impact. But it also kind of obviously dictates the decision around should you invest or should you pay down the mortgage. What that means is when we actually look at the analysis, which we'll get into in terms of more specific numbers in future videos, but just looking at the data is what it means is that there's years, if you have a bad investing experience and coupled with if interest rates are high early on, that's going to make that scenario worse off, or it's going to take a very, very long time for that to make sense, for the debt recycling or investing instead of paying down the mortgage for that to make sense. What I've done here is I've gone back and got the actual returns of a 60-40 portfolio. So we're talking 60% international shares unhedged, 40% Australian. And then what I've done on that, you can't see it here, but just for simplicity, is I've got the individual breakup for that. So obviously growth and income are taxed differently. Similarly, there's franking credit. So this is what makes up this total return is we've got a growth return, we've got an income return, and we've also got franking on that income return to the Australian portion. And so when we look at the total numbers in any given year, and this is calendar years, not financial years, back to 1990, we can see here that this is what that portfolio return pre-tax, and then the analysis, which we'll get into in future videos, will obviously account the after-tax outcomes of that, because at the end of the day, that's what's most important on that. And then coupled with that, so in the exact same period, we've got, I guess, interest rate return, which that's the risk-free return in terms of the option and financial reward that you get if you decide to pay down the mortgage. Obviously, interest rate, we've got this gradual path down. So if you did this in 1990, you said, great, I'm going to invest instead of pay down my mortgage, or I'm going to debt recycle because that's optimal to invest in as opposed to paying down my mortgage. In that year, you've got a negative 16% return on that investment portfolio that's being funded by the good debt, as opposed to you could have just got a 14.52% after-tax risk-free return by putting it against your mortgage. After year one in that equation, obviously you're going to be better off if you pay down the mortgage. The interesting thing with investment returns is it takes 100% return to recap a 50% decline. If you have a bad year up front, it takes a while for it to claw that back. So if there's a bad investment experience early on, like negative 16% and a high interest rate like that, that's going to make that scenario here, if you debt recycled in 1990, it's going to take a while for that to actually make sense, which we'll get into in future videos. And similarly, 2002 was a bad year, and then we get into the GFC obviously as well.
So let me try and just summarize it in my layman's point of view, which is probably most viewers are probably might understand it how I would say it better. What you've done is you've taken the average kind of normal portfolio for investment. You've included the returns, whether that be the dividend or the capital growth put together. Is that right?
Yeah, and deliberately split that up because they're taxed differently. So on dividends, obviously that's taxed on that goes onto your income tax, and then there's a franking credit attached to that. Whereas on the growth, number one, there's the first element that you're not taxed on that growth until it's actually realized, obviously, and you also get the 50% discount on that, presuming you've held it for more than 12 months. So that's why it needs to get an accurate reflection, you need to break that up. That's what makes up this total return here.
Yeah, in the background, there's been a lot of effort gone into to kind of put these numbers together. It hasn't just been kind of get on Mr. Google and kind of do some basic spreadsheet work. There's been a bit of work done behind that. And then basically you're just comparing it to, if someone, let's say they took 100 grand out, that would be the return. Say in 1990, they would have lost 16% in the first year. 14.52 is basically the home loan interest rate, and you would have saved that much because you would have paid down your home loan by 100 grand. Is that correct?
Yeah, and I say like lost 16%. So we've got like just on this particular, I've just hidden those columns for simplicity, but it would have been negative 20%, and there would have been a 3% yield or something like that. So that's kind of the return after including that. So at the end of the day, that's the portfolio balance with that. So that's spot on with that. In terms of the interest rate, like the way that it's a little bit, you kind of got to flip the equation on its head a little bit for that, because what investing, you put that into the market and then that gets dividends, and presumably you reinvest that or kind of consider that in the same pool, and you also get the growth hopefully, so that you can kind of think of $100,000 that there's that portfolio. So if you have a 10% return on $100,000, you've now got $110,000 obviously using that example. Whereas it's a little bit of you kind of got to flip the equation a little bit when you, I guess, paid off the mortgage, because if you put $100,000 against the mortgage, you've still got that $100,000 against that because your mortgage is that much less, or if you put it into the offset account, having that same effect. But that doesn't grow to 114.52%, $114,520 in that. It sits there at $100,000, and then it saves the $14,520, and then that does compound. So this is why I have seen some commentary online, I would say is incorrect, is they say that, well, like paying down your mortgage doesn't have a compound return, but it does. You just got to think about it a little bit differently, because if you think in year one on that scenario, you've saved 14,520, and then that 14,520, which would have otherwise been paid in mortgage, that then can go into paying down the debt. So you can kind of think in year two, you've then got $114,520 that then's reducing it for that 12.75% that next year. So it does compound the same way. It's just the scenario, which we'll get into in future videos, It's just comparing those two scenarios to say, well, what if we put $100,000 into a portfolio and you obviously got the tax deductions, presuming we debt recycle that, as opposed to if we put that against the mortgage and kind of locked in these returns, what would that look like over time?
I mean, we're going to dig into this more later on. What do you think people will be most surprised about once we start digging into these numbers?
Yeah, I think we can come down here and have a little bit of a look into the summary as well. And obviously got the scale here. We can see here that the minimum, like looking at the share market returns, the minimum return, or the worst return was negative 30.5%. So obviously the GFC in that scenario. So that's the absolute worst, and the absolute maximum was 36.69%, which was a couple of years after the recovery of the GFC. So there's obviously a bigger range of investment returns, and what that means is there's a bigger range of outcomes in terms of if you invest as opposed to if you pay down the mortgage. So that, because here, although interest rates were very high in the early 90s, and that gives a big max, you could say that since probably mid-1990s, when the data point on it, like it stabilized somewhat. Obviously, it had the COVID lows with that as well. So in terms of what I think people would be most surprised about is that just, I guess, re-emphasizing that there is a lot of investment risk, as there is with anything. Because I think one thing that I get is people will come to me and say, Kyle, I want to debt recycle. See the hype online, which some people might accuse me of spruiking it and different things like that. But I think at the end of the day, you need to kind of bring it back. And that's what I kind of hope to do with this exercise, is to say, well, at the end of the day, it's an investing decision. With that, say that it's not always, even like if you're a long-term investor, it's not under every single scenario an amazing result by debt recycling to the full lot. Like it can take a very, very long time if you were unlucky enough to start debt recycling 1990 or 2008 or 2002. It can take a while for those to recover, as opposed to if you just pay down the mortgage. Looking at the averages, I think it is one of those just kind of assessing the risk based on the history of this, and then kind of assessing that, well, it was a 15-year kind of break-even period, as opposed to if I just pay down the mortgage. And I think people might be a bit surprised that there are kind of those freak market events, which we can't predict either. Like, nobody knows if it's going to be in 2024 or 2030. It might not be as severe as past years or whatever. But I think that's probably the point, and the thing that most people will be surprised at, that it's not always green light after 7 years or whatever it might be.
Yeah, what's really interesting, which you bring to light, which I don't think when people go into certain, let's call them investment strategies, doesn't really matter what the strategy or the asset is, quite often they go in thinking almost this is a silver bullet, like it can't fail. It's like that stock recommendation that someone gave you that time and you put your money in and it didn't work. And then you were like, okay, well, why didn't that work? I think it's got to do with expectations and actually managing that risk, as you said. I'm no financial planner, that's probably your role, but having that expectation that actually this is not going to 100% work probably allows a good stable frame to view these things through. Would you say that's an accurate kind of summary to make of that?
Yeah, I think 100%. I think a lot of people, as you say, kind of think, well, if I keep costs low, if I diversify, if I'm a long-term investor, the share market is risk-free, and that's always the best option. And I think people can be like, where people get that, and I wouldn't say it's ill-informed, but if you look at the GFC, for instance, I think it was around 5 years, that if you invested $100,000 at the start of the GFC and got the most unlucky person in the world and got that negative 30.5% return straight up, it would have been about 5-6 years until you got your money back. So if you had $100,000, went down to $70,000 and gradually clawed its way back, people think, well, 6 years, I don't care what happens, even if the GFC happens and I'm the unluckiest person in the world, I'm prepared to wait 6 years and it's going to make sense. That's just, I don't know what that'll be, but I'm happy to wait 6 years for the fruit to bear. But what is interesting when you compare it to a mortgage or the risk-free return that you can get is you're not comparing it to $100,000. You're competing against the mortgage interest rate. So it's not a case of saying, well, my $100,000 is now, it went to 70, 6 years later, it's back to $100,000. It's my $100,000. It could have been 160,000, like if you equate that saved interest over that time, because the return of putting your money against your mortgage is always positive, as you can see here. If you go down, you're then, it's like you can kind of think of a running race or a car race.
Yeah.
If you fall behind someone, they're not just staying still there, and you've got to catch it. You've got to kind of race even faster because they're forever moving with that. So that's kind of the equation when you're competing against the mortgage for that. And obviously there's times when interest rates are lower. So during COVID, when interest rates were 2.2%, it wasn't moving ahead as fast. But if there's a time when interest rates are higher and would otherwise be moving at a faster rate, that's what you're competing against. So in terms of what people would be surprised about, I would think like in terms of like the way that I apply this for, I guess, chatting to people or customers, it's a case of like both make sense. So statistically, you're most likely to be better off by debt recycling or investing, but there's plenty of times where it can take a very, very long time, literally 20 years for it to make sense if you did it in 1990 or 2008, which are getting to different scenarios. It's a case of saying, well, maybe I won't debt recycle everything. Maybe I'll debt recycle a portion, 50% or just somewhere in between. But I think it's important for people to at least kind of know that if history repeated itself and I was the unluckiest person in the world, it might be longer for this to bear fruit than I would have thought.
For the audience that are watching, we're actually going to dig deep into like different years, because it is really interesting to see kind of best case scenario, but also the worst case scenario. I'm assuming that's going to be the worst case scenario. When you kind of lay it out and you focus on individual times, I think it's a lot easier for people to go, okay, well, there is risk involved. Maybe I am the most unluckiest person in the world. That sounds like something that would happen to me. Maybe I adjust risk appetite to reflect that.
Yeah, no, I think so I guess in terms of just hoping to set that up to speak about the different concepts in this video, but also if this kind of thinking if it is interesting to you, if you'd like to leave in the comments, like kind of what your income is, what kind of time frame you would be thinking for it to make sense, and when we're going through those future scenarios, we'll kind of try and apply that. Obviously, can't do it for every single case, to try and get an average across that, because I think that's probably another thing that I'm interested in to understand, that how do people think about these strategies for it to make sense? Do they think about it as the same 7-year thing that like makes sense, 2-year thing, 10-year thing? And we can kind of look at those different time frames to see if it makes sense.
Awesome. Well, stay tuned, everyone. If this stuff is interesting to you, we could probably do limitless amounts of videos digging into the data, which is kind of testament to the amount of work on the numbers you've done in the background, which kind of showing this simplistically does hide it a bit. But if anyone wants to get in touch with you, Kyle will put all your details down below. Kyle's got his own YouTube channel, guys, which will be in the link. Please give him a subscribe and watch some of his other videos on debt recycling there if you're keen to follow on the topic.